And I've got old-time guest Kris Pederson here beside me. Welcome along.
Good afternoon.
And thinking the first podcast of the year, what's been going on, and there's nothing better to deal with finance because we can't buy properties without finance, right? And I haven't spoken to Kris for quite a long time, and probably over the last year, and man, there's been a lot happening in the last year in there, Kris.
Yeah, there has.
And from interest rates in sort of highs for the last sort of 5 years down to interest rates acceptable level, where we've seen a massive change over the last sort of since about September, October. But the cash flow rate has come down. It stayed steady last week. I don't know if you want to comment on that. We sort of predicted that. I think you've actually predicted about all the losses of the drops on them during the last 12 months.
Yeah, I mean, I think pretty much everyone expected the cash rate to stay stable, with it being the first appearance at a cash rate review of our new Reserve Bank Governor. I think that was probably more what people were focusing on. And especially the fact that the markets had freaked out a little bit before and started ratcheting interest rates up. They kind of wanted to see some of the commentary, and it's been quite interesting since that review. We've actually seen a number of banks actually drop rates.
Okay.
Yeah. So the midterm rates have actually kind of pulled back a little bit. So it's good to see them going in the right direction.
Yeah. In fact, for people like me that don't sit down, too busy to sit and look at the rates every single day, what's the sort of standard floating rate for most of the major banks at the moment? I'll put you on the spot here a little bit.
Boy, I'm really bad on floating because I literally don't even look at floating. I should better answer that. This is horrific. I should better tell you what a floating rate is, and I just don't even look at those for most cases.
Well, most people don't do them, do they? They fix one
yeah, everyone's pretty much fixing at the moment. So I mean, kind of 1 year rate around the 4.49, 2 year 4.69. We've seen the 3 year rates kind of duck back into that 4.99 mark in the last kind of couple of days.
Yep.
And then you've kind of got the 4 and 5 year rates kind of marginally above that at the moment.
Right.
So it's kind of a bit hard trying to figure out exactly where to pick things, whether you want to go a little bit longer and get a bit more certainty, but you're going to pay a bit more, or most New Zealanders have probably benefited over kind of the majority of the last 10 years, with the exception being the crazy COVID period of actually fixing kind of more on the short-term ledger of things.
Yeah, it'll be interesting, as I said, it's where we will be in 2 years from here with all those people doing those 2 year loans, I guess. It's, I imagine a year or so will be similar to where we are right now, but there's an election at the end of the year and who knows what could happen there.
Exactly. I mean, you definitely could find if some of the bank economists freak out and we had them suddenly thinking that interest rates were going to spike a lot earlier. I still think there's enough rubbish, unfortunately, to work its way through the system. We saw the unemployment rate kind of jump up a little bit higher than was expected, and I think maybe those things put the brakes on a little bit. Yeah,
no, there's still a lot of herd next week into this rates. Sort of couldn't really, go up too much, at the moment, and then probably for a while. But it will explain, 4.5% is pretty good from what it has been the last 3 or 4 years, and that will explain why. Right now, I was just talking to you before we started. First home, what we're seeing, the first home buyer market, and funny enough, actually renovators market's going pretty hot right now, and there's a lot of people there, totally different sort of buyers. The first home buyers markets, they rely on the interest rates that you're talking about, so they can borrow. I guess where the many of the renovator people don't require that, those sort of cash buyers, some of those people. But interesting, the two sort of markets, there's confidence back in those markets at the moment.
Yeah, you definitely look at kind of where prices probably are now and comparable to say kind of 2021. And that first home buyer market, you can actually get some pretty decent stock at a reasonable price these days, and suddenly it's nice to see an interest rate with a forward, in front of it as well. So they combine, better house pricing and a much nicer interest rate than we had, say, a year or two back. Definitely pulling some buyers back into the market from what we can see.
Yeah, and just on that side, there's a lot more sales happening because there are a lot more buyers in the market, and but I'm sort of average that there's a lot of properties are still to come on the market, and that's where I don't see the market going crazy upwards as far as prices go in the next year or so. There's still so many more people holding off. Some of them have run out of time and they're selling now, and that's what we've seen. And I'm sure what I'm seeing, there's still a lot more properties to come on the market in the next year or so. But at least buyers are buying. That's pretty cool for vendors, but they're still selling. Yeah. And even though we are seeing record highs of properties on the market, it's not actually going up too much because we've seen a heap of sales. So
it seems to me to be the closest thing to a normal market I've probably seen in quite a while, where you've kind of got that balance, where it seems everything we're hearing from people who might be selling if their house is presented well and marketed correctly and they're not being too greedy, it'll move.
100%.
That side of things.
Yeah, and that's exactly how the market is.
But on the other side of the equation, if you're a buyer and you're ready to go and you've got your finance ready and stuff, you can still get some okay buyers out there as well.
Yeah, they might miss out on your number one or two,
Yep.
but there's plenty of stock around for them to pick up. So those one or two who've got the properties, those one or two, really nice properties, what have you, they're the ones that are getting reasonable, prices for their property. But the other ones average it out still. So that's great. Okay, yes, yeah, I agree with you. Say the average, more like average market boy since well before COVID, it's been or just no sales at all last, since December 21.
Yeah.
So it's nice to have the market back again and people doing what they want to do and, buy a property and sell if they want to. So that's what it should be all about. So, but one thing, with that normality, and one of the reasons we're here today, I read your latest newsletter that you should all be reading and watching every week or fortnight when Kris puts it out. Which may change this, hopefully not too much, but I was reading about the LVR rates for investors changing, because that's also been like a yo-yo the last 10 years. From used to be 80% lending you could get, then we went back to 60%, and it's gone all over the place. And one of the reasons why you need to have a broker is for the fact that things do change all the time. In fact, I'll talk about this first before we talk about the new rules. But just for example, I had a lady who's wanting to buy an apartment under 40 square metres at the moment, and as many of you will know, some won't know, that under 40 square metres, even 50 I think, some banks don't lend with that category. So she went to a bank, couldn't get finance, and she said, I really love it, it's a shame I can't buy it. So I've sent along to Kris, and at the moment she's in the process of dealing with another bank, and hopefully you can get the finance and she can get the property that she wants, and I'll have a happy vendor. So that's all good. But yeah, so tell us a bit about the investors at the moment, with what they can get with their lending on the properties they already own, and what they can borrow on properties that they want to buy, because this is also news to me as well.
So probably trying to explain the loan to value ratio market, or the loan to value ratio situation for investors. The Reserve Bank regulates all the banks and keeps a pretty close eye on the non-bank market as well. If we go back to 2013, prior to that, the banks were effectively self-regulating. I remember just prior to that, BNZ was doing up to 5 investments at 90%, which was fantastic, and that's why we ended up with big property booms and things like that. Then the Reserve Bank brought in those regulations, and originally they set the investment loan to value restrictions at 80% on an existing property. And as Mark said before, probably from like then right through to now, what we've seen is that when the market's heated up, they've pulled the loan to value ratio down. So for example, around the 2015-2016, we had a bit of a hot market around the country, and we saw originally Auckland was limited to 70 while the rest of the country could get 80. Then to shut the market down, they pulled the LVRs of investments right down to 60. Then in COVID, when economists thought the sky was going to fall on our head, what happened was actually the other side, because interest rates dropped and everyone went on a buying spree. But in the midst of that, the Reserve Bank actually removed the LVR rules. The investment side went back to 80, and we saw investors go pretty crazy, didn't they? Because the market went so crazy, we saw them.
Sorry, going back, that's where unfortunately we're seeing a lot of people hurting now when they're selling, because the market went up 20% 2 years in a row in Auckland, so it went up pretty well 40%, which is just ridiculous and should never happen.
Yeah, it's actually dangerous. Yeah,
and it is dangerous. And now we're still finding, now we're getting probably 1.5 out of 5 buyers we sell their property, they're actually getting
negative equity
because of that. So carry on.
And so to suppose the Reserve Bank effectively forced a recession on the back of 21 going on to 22, on the back of basically inflation, how heated the housing market had got, and to probably limit the damage, they pulled the investment LVRs down to 60%. They were really trying to limit, basically, they were really trying to stop people really transacting, I think, for a while.
And they achieved it.
Yep, the market basically had its lights turned off literally overnight. And slowly what they've basically done since is relax those investment LVR rules. We saw it go from 60 to 65, 65 to 70. And then the part which hasn't really had a huge amount of media attention was circa, I think it was mid-October to November last year, the Reserve Bank actually came out and made an announcement about some relaxing in the LVR rules that they've not done previously. So while the main settings are still actually at 70% LVR, for a long time, whatever the investment LVR has been set at, the banks have had a 5% exception where they can do some lending outside that. In the investment space, the banks have never used that 5% exception. It's too small. They're probably, maybe they've done it on transactions that I don't see where they might do it in a divorce or for a house where there's remedial issues where they can go outside the rules and special circumstances.
Yeah.
But they definitely haven't allowed the standard investor to come along and get some of that exception, if that makes sense.
Yeah.
So the change that was made on the back end of last year was that the exception was increased to up to 10% of the bank's lending could be done on LVRs above the 70% threshold. Now, we've only had one bank formally come out and say that they're happy to do it. I was quite surprised that they came out and they actually said they're happy to look at investment lending all the way to 85%. At the moment, we've just been more recommending clients just go up to 80%, because up to 80% you'll still get standard pricing, you'll get good cash backs, you'll get the good interest rates, all this stuff. Up to 85, you'll end up paying more for your money.
Yeah.
We didn't commentate on it or market it or anything like that when it first came out last year, because we wanted to test the products out for ourselves. We've had situations before where banks say things and then you go try them out and they don't work.
Yeah.
But we managed to get a number of these kind of transactions put through basically prior to Christmas.
Right.
Because they've only got a limited amount of funding in the space, it will turn on and off. So what we saw is that operated for a month or so, turned off probably I think for a period in January, and then we were notified, must be a couple of weeks back, something like that they basically had capacity again. So this is going to go on and off, I'll basically say through this year or until maybe the Reserve Bank tinkers and changes with more restrictions.
So who are the main people who will benefit from this? Are these investors who already have 3 or 5, 6 properties, or newbie investors coming on board?
So the big part we've been trying to tell them, we at KPM, we deal with a lot of people with multiple properties, but we also deal with a lot of people who might have, say, a family home and an investment. And one of the big things we're recommending, and we've always said this as a business, is to split bank, where you have your personal home away from your rental property. And in this case here, the big reason of doing it is if you've got your home and a rental property or rental properties with the same bank, what happens is when those LVR rules get pulled down, they basically they average it across the properties with that bank. If you can separate them, so your investment side is away from your home side, that enables you in times like now to leverage up to 80, pull the equity across into your home, and then basically the whole way through, since we've first seen the LVR rules come in back in 2013, as long as you've met the other bank criteria, you've always been able to leverage your home back to 80%.
Right.
So what we're trying to do is go use this opportunity now where you've got this higher ability to leverage, push the investment side up, put it across to your home, make sure it's separated, pay it down on your home. But basically it means that if you want to be in a position to move forward, let's say the property market picks up again, the Reserve Bank starts tinkering with these LVR rules, you've got the equity in the right place where you should be able to access it. Even if you're not wanting to do anything in the market now, great chance to take advantage of setting yourself up properly for that next upswing. Great thing at the moment is as well as, I'm sure you've heard about some of the cash contributions that the banks have been throwing out. So
They've been pretty good, have they?
Yeah, so I mean, I don't know if we're ever going to see this again, but on the back end of last year, we had pretty much all the banks were doing up to 1.5%.
Wow. Which
Which basically means if you had $1 million mortgage, the bank was giving you a nice $15,000 kind of sweetener on the deal. That made the market absolutely manic for about 2 months. So that price offers basically left the market, as I just said before, not sure if we'll ever see that again, but kind of standard cash contributions are around that kind of 0.9%. So in that case, $1 million loan, 9,000. So a lot of this kind of restructuring work, what we're saying with clients is you can probably restructure, set yourself up properly for the long run and get a bit of cash off the bank or maybe a new bank in the process of doing it. So you're profiting while you're doing this as well.
Right.
So it's quite a good way to set yourself
absolutely. I'm talking actually to the Property Investor Association, some new investors there tonight, and we're just talking about opportunities and why investors actually sell property and what have you. It's all about the opportunity at the right time, and this is obviously an opportunity right now for those investors who do have investment property in their home of coming in while the opportunities there to actually getting more equity in your own home and maximising up to 80% on your rental properties. Now is a great time to come and see your broker to do that right at the moment. So yeah, good.
And another little trick we've seen as well is let's say that part there can't work right now. Let's say the bank or banks which basically looking to do this kind of shut out of the market. We've actually got the non-bank market is relaxed. So what we've seen change is, in my opinion, the banking market has got over-regulated. And so now what we're seeing is the banks are providing the non-banks with capital, and the non-banks getting around the rules to an extent that way. So what you've got is we're getting an increasing amount of non-bank lenders come into the market. They are predominantly funded by the banks directly, but they can do things the banks can't. What had happened for a large amount of years is that those non-banks which were bank funded had to abide by things like the LVR rules. So if a bank had a LVR set at 70, the non-bank was set at 70. I was at the cricket, must be roughly around this time last year in Hamilton, and one of the non-bank guys came up to me and he said, KP, I've actually kind of had some feedback from the Reserve Bank and stuff that they're looking at the non-bank market and they're not too concerned about it. And so they were happy to relax it, and so we're going to be able to go outside those bank rules on the LVR side, even though we're being funded through the banks. So we've started to see situations where the non-banks have been able to push up higher on the LVR side. We've actually got one non-bank going all the way up to 90% on existing investment properties. You're paying more for it, but we've got kind of different options there. And one little trick is as well is there's another exemption, shall we call it, in the rules, which basically means even if you're sitting outside the loan to value rules, you can basically go and do what's known as a dollar for dollar refinance, where you can go from one lender to another as long as you're not borrowing one more dollar. So we've had some success where we've basically had clients who might have been at a non-bank lender at, let's say, call it 80%, and then they've been able to refinance across to a bank lender because they're not borrowing anything more, if that makes sense. So there's little kind of ways that you can kind of play the game there as well, even if you can't make that first option work. We're always going to try and bank fund work as a first option, but if we can't bank fund, there's non-bank solutions where you can kind of end up with a good option to make a deal work as well.
Great. I know KPM's for over the last decade or so, probably a couple of decades, you're showing
getting old.
Have you dealt with non-lending banks a lot over the years? What sort of, probably going to be the answer, probably going to be depends, but what sort of interest rates, how much above the standard rates do they charge now?
You answered a bit with it depends comment, but it's kind of, at the moment you're probably anywhere from the high fives up to a lot higher, depending on the risk side of things. And when I say a lot higher, we've got non-banks who will do things outside of just LVRs. So we've got non-bank lenders who are a lot more relaxed on the income side. We've got non-bank lenders who are a lot more relaxed on certain security types. And so we've got probably the best part of, must be 30 to 40 non-bank lenders we use at the moment. On that point, my next meeting, I've got my business partner and myself actually got a lunch. We're quite excited about one non-bank lender who we want to clarify these points before we talk more about it. But there's a lot of people who might have had mortgages through a non-bank lender and they're on a relatively high interest rate. From what we've heard, this non-bank lender, all they'll do is, as long as the existing mortgage, which is at another non-bank, has perfect payment history for at least 3 months, so 3 months or more, they'll look to potentially refinance across to them. And in most cases, they're significantly cheaper than the majority of other lenders in the non-bank market. And all you have to do is basically provide a standard application form, 3 months payment history, and I think that's about it. You don't have to provide income proof or anything. So that's one of the things we'll be looking at, because we've had people who, for whatever reason, may have ended up being at a higher asset lender because they might not have been able to meet income criteria or this type of thing. And so for those of you who maybe are stuck on an interest rate in the 7s or 8s or something like this, as long as you're paying your mortgage and as long as your security type's fine, this is not for the development market. You can't really pull over a half-finished development to this lender. We're thinking this might be a way to save some people a few bucks as well. So we're taking the New Zealand head out for a bit of a lunch later on. So the positive thing I see is both Mark and I reminisce often about stories coming out of the GFC, which was not a fun time by any means. What happened there is there just wasn't liquidity. There was no money around, really. What's been different this time is really there's actually been a lot of money around still. I mean, you'll see there's heaps of people with cash. The banks have had cash. The non-bank market is awash with cash. People are actually wanting to lend. The banks, I don't expect to free up too much because they're regulated. They want to, but they can't, if that makes sense. But I think we'll continue to see more and more options come through the non-bank market as more entrants come in, they'll get more and more price competitive. And yeah, I think that's quite positive for moving forward.
Yeah, no, definitely. It's an interesting sort of time in the market because there's a lot of money around, and it's being used, as I said, and it's being used wisely, probably more than in the past. And at the same time, of course, as many Kiwis know, there's a hell of a lot of hurt around there as well, and there's a lot of people still recovering, from five years ago, and when the market's doing a bit, but also just with life, generally trying to get on with it, sort of thing. So, but yeah, it's good to see money being used wisely to help people out. So it's all good. So what about so the first home buyers that are watching this? I see first home buyers far more educated now than they used to be 10 years ago. Maybe technology and things like podcasts here and what have you help with that. But they seem to be pretty onto it and organising and getting their finances. Is there any tips or anything you can give to like a first home buyer for what they should be doing before they're starting to look at buying a property?
So firstly, on the first home buyers, where it's worth making a comment as well, when I was talking about those LVR thresholds, if we flip that across to the owner-occupied market, when the Reserve Bank brought the rules in, what they've done, I suppose, consistently over the last 10, 12 years, is that there's been this line in the sand of 80%. So the one thing that they've changed, I suppose, over the last 10 to 12 years has been the lending above the 80% threshold, or when you've been able to access funding with less than a 20% deposit. So what basically the Reserve Bank has done is that they've made it, I think when they first brought it in, the banks were able to do up to 10% of their total lending on mortgages with less than a 20% deposit for people to buy their home. If I use an extreme case, we've seen that basically extend out to 20% before, when they basically wanted to encourage first home buyers into the market. If we go to the back end of 21, when the Reserve Bank, as I said before, effectively engineered a recession and a property crash to an extent, they pulled that right back to 10%, which is actually quite a small number, because the banks can't struggle to manage that, and that was designed to make it very hard for first home buyers to get into the market. They didn't want people buying in with small deposits while they were pushing house prices down. What they did at the same time is they changed that loan to value rule in the back end of last year, as they pushed that number all the way up to 25%, which is the highest that's ever been since the introduction. That's the Reserve Bank saying we want first home buyers in the market. We're going to play our part in encouraging it, and I think that also goes into what you're saying. You're seeing them. And what we've seen at different times over the last 10, 12 years is first home buyers getting very frustrated when a market starts picking up, because banks will suddenly, if they're running out of their capacity, suddenly what happens, it becomes quite hard for first home buyers to get into the market. And often, if you've got less than a 20% deposit and you're competing against those who've got 20% or more, it gets difficult. You might be going into auctions. If you've got less than a 20% deposit, you've often got to pay for valuations. And you're competing against people who don't, because they've got 20% or more. We see the first home buyer market get very frustrated, because we've seen people pay for 10 different valuations without securing a house this type of market. If that makes sense.
See that but again at the moment.
And that's the part I'd sit there and say, if you're one of those buyers, this is a good market to get in, because you've got capacity inside the banks to fund. You shouldn't be burning too many of those, even though market basically said is starting to change a bit. I suppose to answer Mark's question, excuse me my little sideline comments there, the biggest thing I always say is to be pre-approved. Do note on that, if you're a first home buyer, if you've got 20% or more, you should always be trying to get pre-approved. The amount of people, and I'm sure you see this as well, who look to sign basically a property up, you've probably got multiple people who are interested in the property, they haven't even started their finance process, they get frustrated with it taking 2-3 weeks for the bank messing around, all that type of stuff, and they probably invariably miss out on the property because other people are interested. And so for me, don't go find the property and then start your finance journey. Go through the process of getting pre-approved. A pre-approval basically means that you're ticked off as the borrower, and then in most cases it's just a case of the bank having to sign off the security property which you're looking to buy. That will generally mean that you might only need a couple of days for the bank to do that versus a couple of weeks. It also means that you're focusing on, is this the right property for you? You can focus on making sure you're paying the right price, doing your due diligence, all that stuff, rather than worrying about whether you can get the money or not.
And a few things that you say too, you must know how much you've got before you start negotiating, especially if it's a nice property. We had one in Glenfield just a couple of days before Christmas, and deadline sale, and we had 12 in a multi-offer, and they were all first-home buyers, and they all had exactly the same clause. They needed a limb, they needed a finance, and they needed a buildings report. All 10 days. One buyer who had been to broker knew exactly what they had. They went to 7 days because they knew they didn't really need to 10 days, even though the solicitor saying through 10 days. That's what that's what solicitors say. They're risk averse as well. And that person got it. They paid more also because they knew exactly what they could do. They loved the property like everyone else, but they were super organised, and they one of over 11 other people that didn't. So that's just be organised, get your finance up front. It's interesting what you say now. And banks are so risk averse, and if they're now lending 25% of their money to first home buyers above 80%, they're pretty confident that we've gone to the bottom of the market. Like we all.
That's definitely the Reserve Bank who drives that, and that's them going with the complete opposite to where we were in 21, where property prices were inflated. They needed to come down. That's them basically saying, okay, we're at a safe level again. We're fine with first home buyers getting back in. We want to see the first home buyers basically kind of getting out, and it's a good time for them to basically buy. I would just sit there and clarify, if you've got the 20% or larger, you can get pre-approved, and you can generally get pre-approved up to 6 months. If you've got less than 20%, in most cases, the banks will generally require you to find the property first and then approach them. So that part's a little bit different. They won't generally allow you to do these open pre-approvals without a property being in mind, because they don't want to be wrapping up that limited amount of, I suppose, space they have for people who don't have properties. So that's the difference. 20% or more, get pre-approved, get yourself ready.
That's pretty good.
And so banks will basically kind of, in most cases, they might give you, for example, a 3-month approval, and then you just come back to us, or we'll generally proactively go to you and go, can you please confirm that your basic situation, income, you haven't taken any more debts on, is all roughly the same. And then they'll roll that for another 3 months. So 6 months total. If you haven't found anything in that 6 months, basically you'd have to provide the pay slips, bank statements, all that again, and roll that process over.
Hey, just tell me, I know going back to December 21 when the triple CFA rules come in and stopped all lending, and as I said, that already stopped the investors, and that stopped anyone getting lending, because I think if you've been to a pub and had 1 pint, or you've been to a TAB on Melbourne Cup Day, they thought you were a risk and didn't lend any money. Are those sorts of things much easier now for all people?
They're gone. I mean, it's... If you're a conspiracy theorist, you wrap that in with the whole thing that they were trying to turn the market off. Because if you look again, when it happened, literally the market for finance got turned off overnight. And it seems, I suppose, if you look back, you wonder how coordinated the whole thing was. Because, again, Mark and I went through the GFC, and that was pretty brutal, and the market changed pretty quickly. I think this changed a lot faster. It went from like the market being absolutely crazy on the back of 21 to being turned off in January 20.
And it was crazy for 2 years. It shouldn't be like that as well. But I remember December 21, we had six offers, first home buyers or first home investors, and they all under contract, and all of a sudden they all got told to get finance. None of them got approved. So we had 4 deals crash in December that year. I've started a bit of a mini slide for a little while, but
the biggest thing I'd sit there and say is that level of, and I will call it stupidity, has left the banking market. Unfortunately, one thing which we've found with the banks is, historically, you go back 10, 20 years, all this type of stuff, you were dealing with bankers who'd have a level of common sense where they could look through a transaction and go, fundamentally, you're a good borrower. There might be a couple of quirks in the situation, but the deal's good. What we've found now, unfortunately, is there's much more of a box ticking mentality. And so bankers don't probably have the same, and this is not a beat up on individual bankers, it's more that their autonomy or discretion's been taken away from them, if that makes sense. And that's probably the world we live in. There are a lot of things are being automated, technology is being used a lot more, this type of stuff. And so that's where we're finding, if you've got quirky situations, that's where things are taking either a lot longer or it's a lot harder, and that's where non-banks are coming in more and more to fill those gaps.
That's no questions. If someone comes in and says, got a place under contract, got 10 days, working days to get finance, you can usually turn it around in 10 days still?
Normally, that's without having anything from the client. This is where I've got to be careful.
Okay, good. If they have pre-approval, it's a matter of just seeing the sale and purchase agreement. And
this is the big reason we're saying pre-approval, because the parts which are difficult, just to clarify, is most people will look at their situation, and because you know your own details intricately, it may not look complicated, but we deal with a huge amount of self-employed people, for example, And so we run into situations all the time where maybe someone doesn't have their books up to date,
Yeah.
if that makes sense. And what we've noticed is that there's, if you work in a trade, so the construction area has been really hardly hit in the last 2-3 years.
Yeah.
And so what happens is it's not just basically the year-end financial statements, but it's what we call management statements. The banks want to sit there and go like, we're coming up to the end of a financial year, end of the month.
Yeah.
They want to know how this current year's going.
Yeah.
Things like zero reports, all that type of stuff.
Yeah.
So if someone comes to me today and says 10 days,
Yeah.
if you're salaried, all that, it's probably easy.
Yeah.
But if you're self-employed, if you've got quirks, if you've got these other things, that's where things can take weeks to
And the other side flip is if they are pre-approved, does that mean that they can go unconditional, or the bank still want to see the sale and purchase agreement?
They want to see the sale and purchase agreement. Great question. Yeah.
So they would need what, as a very minimum? I'm trying to think of a way people listening to this, first time buyers, can get ahead of other, win options, or win not options, but win a multi-offer situation over others. Can they do it in like 5 working days, or 2 or 3 working days, or
generally 2? So what we say to all our first home buyers, and actually all of our clients who are pre-approved in general, is, as I said, we're trying to get you as the borrower signed off. So that's your income, the bank statements, ID, everything to do with you, and the only conditions we're trying to leave are relating to the eventual property that you're looking to buy.
Yeah.
In most cases, what we're then telling clients is, try and, if you see a property which is of interest, just ask the agent that you're dealing with for a draft copy of the sale and purchase agreement.
Yep.
Because then what we can do is we can put that past the bank. The bank these days, they do this more than they used to, is they'll tend to jump online, have a look at the marketing spiel, see if there's anything that they're concerned of there. The vast majority of cases that will then go through, if that makes sense. The times where you may have the bank come back and need more information, if you've got a monolithically clad house, right? They may be then kind of come back to a condition for a building inspection.
Yeah.
Sometimes you'll get further terms and conditions in the sale and purchase agreement. That might be if there's something in there that might raise questions with the banks. But if you've got a straightforward property, weatherboard, brick and tile, where everything's pretty stable, then what you'll find, but if you're pre-approved and you provide that S&P, you can be going unconditional within 1 to 2 working days.
Right.
Real fast.
Yeah.
And Mark and I have both been investors and messed around with property for a long time. Speed is of the essence for everything. So even if you're a first home buyer, you still want to try and get a good deal. So get yourself ready.
Yeah, and you'll win many multiple offers just because you're ready. You can go in 2 days, where they've got to wait for 10 days. And 10 days is telling them, should be telling the agent if they're educated enough, and telling the vendor that that they aren't as prepared as a 2-day one. So what's more likely to go through? The 2-day one.
I mean, you must have seen quite a few cases where the person with a very clean offer but at a lower price ended up buying it over the person with maybe more of a messy offer, but they're offering more.
And we recommend that as well, unless there's $100,000 difference or so. And that's okay. And that's one of the things that has just changed with us lately too. We've actually changed our agency agreements, where we now have to disclose to the banks on a sale and purchase agreement, where we sometimes had a side agreement sort of thing. But if there's anything wrong with the property or unconsented work, now you might not know the answer of this, but if we have in there, for example, there's a bathroom that's just been modified and the showers now are over there, and it needs waterproofing, and we'll have it waterproof and what have you, and hasn't been signed off. Might be we might have a PS3 from the plumber or whatever to say it's all been done, but it hasn't been signed off. We now have to disclose it in the sale and purchase agreement. So there's no hiding, because we're not allowed to do that to the bank as well. We aren't allowed to have purchase as well. You might not have said know the answer to this, but will they still accept a property just because he's disclosed that he's not something done to it? And maybe the CCC's been done, has got a PS3 from the plumber, so it's been done properly. It just hasn't been consented. So then it's an individual choice as a buyer who they buy or not, but the bank has to agree with it, obviously.
Often we then find this can then go onto the insurance. So banks generally want the insurance, so this is the house insurance we're talking about here, to basically have no exclusions. Because the way banks are looking at it is they're lending someone money, then basically if the house burns down, falls down, something happens to it, they want the insurance to basically cover them, because they're effectively the interested party. They want to make sure their mortgage gets paid back, if that makes sense. So they generally want no exclusions in the insurance. So it will come down to that side there. I'm not an insurance expert on that, but I think what we've generally found, and that this kind of gets into a little bit of grey because there's case by cases and stuff like that.
Yeah, of course.
But you'll find that I think if the insurance was fine and it was seen to be quite minor, then it's okay. So you'll find these type of situations here. I live down in Devonport, which is a whole lot of old houses, and there's a heap of property there with unconsented works. It's very, very common. And so you often see properties with these type of situations coming up, unconsented decks, all this type of stuff. And so another one of the things that the bank may look at in some cases is going, okay, if remedial work is needed, does the borrower have that work, those additional funds there to cover it, if it makes sense?
Okay.
So if someone's coming in with the absolute minimum deposit, the house needs work, they've got no additional money, that may ask questions sometimes.
So one of the things a buyer should be doing early on in their if they found a property they like, it's been disclosed that they hasn't got CCC for any reason, is getting onto the insurance company that they might not normally do to the day before. Ring up insurance company early, just go, hey, I'm looking at buying a house, can you show us your policy? And if there's no exclusions, then they will potentially be right.
If the property doesn't have code, then the bank won't fund it. So if it's got code, or it's got a safe and sanitary and that kind of stuff there, so it's more if it's got those minor issues, which I think kind of you were talking about which can be quite a minor issue.
Because we get one all the time. There might be a sink in the garage.
It
hasn't been the sink and it shouldn't be there. So they say, well, we'll put it on the sale and purchase agreement. We'll take it out if the purchaser doesn't want it. I'm going, well, what does the bank think of this? Do they, because it's a bit of a naff thing. It's not really affecting anything.
And from us looking on the investment side, there's so many of these types of properties where they're so easy to remove those issues. It's really a classic one we've seen issues with is, for example, like kind of maybe an unconsented carport or something like this. There's no structural issues. They're very cheap to remove in most cases. It's not, the buyer's fine with it. It's very clear. You can see the carport. It doesn't affect the integrity of the house or anything like that, but sometimes you get weird things like that kind of popping up.
No, all good. Okay, well, it's been a great chat there, Kris, and hopefully the watchers have benefited a lot from it for today, as things are on the 26th of February. 26.
Year's taken over.
You got anything else that you want to add, or anything exciting stuff, or
No, it's pretty much kind of covered most of it. I'll just sit there and say, kind of as before, on the interest rate side, I think this year, or the next 6 months in particular, we'll probably see a reasonably level property market. I think kind of what we've seen historically is in the few months leading into an election, sometimes goes a little bit quiet. So I think there should be some quite good buying opportunities this year.
Later in the year, I reckon.
And then generally, even though we might see interest rates nudge up towards the end of next year, going kind of into 2027, the general perception is that kind of the economy is going to start to pick up. Then things will tick over more. So while I don't think we're going to see a crazy property market like we did back through COVID or anything like that, I wouldn't be surprised if the best buying opportunities are more this year.
And all the recoveries that they've talked about in the last couple of years has taken longer and longer and longer. I know all the economists the last 3 years have been saying, property market should go up 5% this year. And they've been consistent with that, and it hasn't happened. It's just remained the same, and they're saying it again this year. Some hope they might be right this year. But as you're saying earlier on, this is probably the closest we've got to a normal market, and for me personally, I think it's a perfect market because it's not going like that, it's not going like that. People can buy property, people can sell property, and that's a good thing. I mean, the way I look at it.
It's kind of, you get a bit used to the crazy markets, whether they're going up or down, and this just feels kind of almost stable. So it's quite an unusual feeling for someone like Mark and I who
used to get stressed all the time.
Whether it's up or down.
Okay. Thanks very much for your time. Hope you won't be a year or so from next visit to here, but hope you've enjoyed the podcast. I'll be back sooner than the last one, and we'll see you soon.
Thank you.